And so despite valuations, despite the great deal of uncertainty as to what the inflation outlook, the Omicron outlook, adjustment of supply chains and the such, you still see some of the same themes carrying through from this year?
Good morning. Yes, I think so. I think that people are being cautious because they don't need to be more than that right now. Because of this equity market, in a sense, is this TINA environment. There is no alternative. That people can basically say, look, we're going to have good earnings growth, but there's some uncertainty out there and we should be a little bit cautious. It'll be challenging. It's always challenging. There's always uncertainty. What we do know is that there is still plenty of liquidity and earnings look really good. I think the risks are actually on the upside here, that people are not exposed as much to growth equity. There is this sense here that liquidity is going away, but it's not really anytime soon. Unless we see a real shift to quantitative tightening, which we haven't really heard much about from anyone yet, then there's just this cash on the sidelines still that is going to continue to look for a home in longer duration assets like tech. Supply chains in tech will improve. There's still tremendous demand. Yes, valuations are stretched, but earnings, I think, have upside, room to be revised upside from here as well.
You talk about the speed with which disinflation will take hold as being one of, I guess, if you can call it a contrarian view. It's very difficult to hold those views in these sort of rocky, volatile markets and uncertain times. But how does that potentially play out for an investor?
Well, I think that people tend to straight line views a little bit. It's hard when we're seeing such inflationary pressure build up. We're not quite sure what it all means because we haven't been here in so long. But from checks with distributors and listening to calls from our manufacturers, well, there's something that's quite interesting that's happening here. Is that the sort of unrelated drivers, not totally unrelated, semi-unrelated drivers of inflation. One is this, let's call it chip shortage, the COVID labor force issues, and sort of the manufacturing getting back online is one. And the other one is transportation infrastructure, distribution through ports and trains and freight, et cetera. What's been happening is that as the backup as we get all this floating inventory off the coast of Long Beach, for example, that has allowed manufacturers to catch up with inventory. So yes, we still have these backlogs, but by the time these ships return, there's actually going to be we'll be in a much better place to get items, the goods and services, into the hands of people a lot quicker. And I think that that's going to be one of the surprises that we see as we head into the new year in Q1, is that disinflation will happen quicker than we think. Yeah, we're already seeing that roll over in the data, actually.
And we get more inflation data in a few hours in the US and more data on consumer confidence as well. We got some data already on consumer confidence today. How concerned will the Federal Reserve be about the data that comes out on Thursday morning in the United States, core PCE and so on?
Well, yes, look, they'll be concerned. We know they are. We know that they've also been quite masterful in their shift in tone. I think the last FOMC meeting was a masterclass where Powell actually turned he turned the tables a bit. He said, look, we're more worried, we're more cautious. Maybe we were wrong about transitory, without actually changing the market view on anything and de-emphasizing the 2023 dots. So I really thought that was fantastic. In fact, when we look at in the sort of week before Thanksgiving in the US, 3 hikes were priced in, and then now 3 hikes are priced in for 2022, yet break-evens on the 5-year and 10-year are actually lower. So the market is actually becoming less concerned, even though the Fed has sort of signaled that it's on their radar now, just as prices are rolling over. I think they've put themselves in a good spot.
What's the likelihood that something out of Europe or China might derail the US recovery?
Look, it's always political risk is always a difficult topic to quantify. I mean, it would definitely have a risk. I think the part that we struggle with is we all know that better collaboration helps almost every issue we're in and actually can further growth for not just the U.S. and China, but both regions along the way. That's the case with COVID, with with medicine, with almost everything we see. So the fact that we still have tariffs that are weighing on prices as well, or pressuring prices and weighing on growth is it's something we need to deal with. The idea that we would get more tensions, and because it's a political move, not necessarily one that has much rationale in the marketplaces, is tough to it will be tough to deal with. I'm hopeful, and maybe just hopeful without quantifying it, that we can get past that and cooler heads will prevail and we'll actually move towards a better situation in 2022.